Stop looking at the screen. What you are seeing is not real. Stop looking at the ticker tape in New York. Stop refreshing the COMEX price on your phone. Stop trusting the green candles, the $3 spikes, the charts that pretend to tell you the truth. Because what you are looking at is not the price of silver. It is a reflection, a shadow, a ghost generated by a paper system that is losing its grip on reality. You think silver is trading at $24, $25, maybe $26 an ounce. You think you understand the market because you see green candles forming on your screen. You think the rally has already happened, but it hasn't. What you are watching is a hallucination, a paper derivative price created inside a financial system that is being strangled by a liquidity crisis, the likes of which we have not seen in over 40 years. The real market is not in New York. The real market is not on COMEX. The real market is not on your phone. The real market is 5,000 miles to the east. And there, silver is not 25. It is approaching $100 an ounce. Two prices. One metal. A broken world. Right now, as we speak, the physical silver market in China is trading at a premium so extreme that when converted to US dollars, it approaches $100 per ounce. Not a typo, not speculation, not a theory. A real transaction price paid by industrial buyers, refiners, manufacturers, and sovereign-linked entities. This is not retail hype. This is not social media noise. This is industrial demand colliding with physical scarcity. And the gap between New York and Shanghai, approximately $25 per ounce. In professional trading, we don't call that normal. We don't call that healthy. We don't even call that volatile. We call that a broken market. The $25 vacuum, a $20 gap between two global silver markets, is not a spread. It is a vacuum. A vacuum so powerful that it behaves like a black hole, sucking every available ounce of physical silver out of the West and dragging it relentlessly toward the East. This is not theory. This is not opinion. This is arbitrage at a scale that destroys systems. When such a gap exists, capital does not hesitate. Metal does not sit idle. Vaults do not stay full. Silver moves, and it moves fast. Paper silver versus real silver. To understand why this is happening, you must first understand one critical truth. The price you see in New York is not the price of silver. It is the price of a futures contract, a promise, a derivative, a paper claim. COMEX. Silver is not metal, it is leverage. For every single ounce of registered silver in COMEX vaults, there are dozens, sometimes hundreds, of paper claims. This system works only under one condition. Most people never ask for delivery. The moment they do, the illusion collapses. China does not buy promises. China does not trade silver the way the West does. China buys metal, bars, ingots, deliverable ounces. Silver in China is not a speculative asset. It is a strategic industrial input. Solar panels, electric vehicles, semiconductors, military electronics, energy infrastructure. When China pays a premium, it is not because of emotion. It is because they cannot afford to stop production. The West is bleeding inventory. Every ounce that leaves a Western vault weakens the paper market. COMEX inventories are not just declining, they are being drained. London vaults are seeing persistent outflows. ETF redemptions are turning into physical exports. Bars are being melted, recast, and shipped east. This is not investment demand. This is supply chain stress. Why the price in New York has no choice. The New York price cannot stay low. It doesn't matter how many paper contracts are sold. It doesn't matter how many algorithms push the chart down. It doesn't matter how many analysts dismiss the move as temporary, because physical reality always wins. When enough metal leaves the system, only two outcomes remain: price explodes higher, market defaults. There is no third option. This is not a silver story. This is a currency story. Silver is not rising because it is shiny. Silver is rising because trust is falling. Trust in fiat currencies, trust in paper claims, trust in leveraged markets. China understands this. Asia understands this. The West is still pretending it doesn't matter. The dam is already cracked. Markets do not collapse in one dramatic moment. They fracture silently, then suddenly. The East has already set the price. The West just hasn't admitted it yet. And when New York finally reconnects with physical reality, the move will not be slow. It will not be orderly. It will not be polite. It will be violent. The arbitrage machine, how the East is draining the West. Ounce by ounce, arbitrage is not a theory. It is a weapon. In textbooks, arbitrage is described as a simple concept. Buy low in one market, sell high in another. Close the gap, move on. But in the real world, especially in metals, arbitrage is not a strategy. It is a machine, and once it turns on, it does not stop until something breaks. Right now, that machine is running at full speed between New York and Shanghai. How the arbitrage actually works. This is not retail traders clicking buttons. This is not hedge funds chasing momentum. This is industrial scale capital exploiting a structural failure. Here is how it unfolds. A trader, institution, or state-linked entity observes a 25 per ounce gap between paper silver in the West and physical silver in China. They do not buy charts. They do not buy futures. They secure physical metal. They source silver bars from London, from COMEX eligible vaults, from ETF redemptions, from refineries willing to deliver. Once secured, that silver is shipped, quietly, methodically, eastward. When it arrives in Asia, it is sold not as speculation, but as industrial supply. The profit is not theoretical. It is locked in the moment the metal changes hands. Why this gap cannot self-correct. In a normal market, arbitrage closes gaps quickly, but this is not a normal market. The Western price is capped by paper leverage. The Eastern price is driven by physical necessity. Paper markets can create infinite supply with keystrokes. Physical markets cannot. This means the Western price can be suppressed far longer than logic would suggest, but only as long as metal remains available. Once that metal is gone, the arbitrage does not disappear. It becomes destructive. The inventory problem. No one wants to discuss. COMEX does not trade silver the way people think it does. The vast majority of contracts are never intended for delivery. They are rolled, offset, closed. Delivery is the exception. But when delivery demand rises, even slightly, the math becomes terrifying. Because the total registered silver available for delivery is only a fraction of the open interest. This means, if even a small percentage of contract holders stand for delivery, the system strains. If a larger percentage does, the system fractures. If a critical mass does, the system fails. London, the silent collapse. London is often described as deep and liquid. But liquidity is not the same as availability. Much of London's silver is leased, encumbered, swapped, promised, multiple times over. Bars listed on balance sheets are not always bars that can move. When physical demand rises simultaneously in Asia, something breaks, and that something is time. Delivery delays, stretch, premiums rise, confidence erodes. ETFs, the backdoor drain. ETFs are marketed as passive exposure, but they are also a pipeline. When large players redeem ETF shares, they do not receive cash. They receive metal. That metal does not sit idle. It moves. And increasingly, it moves east. Every redemption tightens supply. Every outflow weakens the paper structure. Why China can pay $100. The question everyone asks is simple. Why would anyone pay $100 when New York says $25? The answer is uncomfortable, because New York is irrelevant to physical buyers. If a Chinese manufacturer needs silver to keep a production line running, price is secondary. If a solar manufacturer misses deliveries, the loss is exponential. If a state-backed entity needs strategic stockpiles, cost is a rounding error. In those scenarios, $100 silver is not expensive. Not having silver is catastrophic. Paper selling cannot create metal. Western markets respond to rising prices with selling. More contracts, more shorts, more leverage. This works until it doesn't. You cannot print ounces. You cannot hedge shortages away. You cannot settle physical demand with promises forever. At some point, sellers are forced to buy back contracts they can no longer honor. That is when price stops obeying models. The feedback loop from hell. Here is the loop that destroys markets. Physical premiums rise in Asia. Arbitrage pulls metal from the Western inventories fall. Delivery risk increases. Confidence erodes. More players demand physical, even more metal leaves. This loop feeds on itself, and it accelerates. Why this time is different. Silver shortages are not new. What is new is simultaneous demand. Industrial demand is at record highs. Investment demand is returning. Green energy consumption is exploding. Military and strategic demand is rising. Mine supply is stagnant. At the same time, above-ground inventories are thin. There is no buffer. There is no hidden stockpile waiting to save the market. The myth of above-ground silver. People assume silver is abundant because it exists somewhere. But availability is not about existence. It is about willingness to sell. Silver locked inside electronics is not supply. Silver held by sovereigns is not supply. Silver held for strategic purposes is not supply. Only one category matters: metal that can be delivered now. That category is shrinking. When arbitrage becomes panic, arbitrage is rational. Panic is not. But arbitrage creates panic when it exposes fragility. Once traders realize inventories cannot meet demand, behavior changes. Suddenly, no one wants paper. Everyone wants bars. At that moment, spreads do not close gradually, they snap. The moment price. Escapes control markets rely on belief. belief that contracts will be honored, belief that metal exists, belief that delivery will occur. Once belief cracks, price detaches. And when price detaches in metals, moves are vertical, not because people are greedy, because people are afraid. This is why $100 is not the end. $100 silver sounds extreme, but extremes are defined by systems, not by numbers. If the paper system fails to deliver, price becomes irrelevant. What matters is access, and access will be restricted. The East understands time. The West believes in control. China is not in a hurry. They let the arbitrage do the work. They let the West drain itself. They pay premiums quietly, patiently, relentlessly. The West believes it can manage price. History says otherwise. The trap is already set. When enough metal is gone, the paper market faces a choice. Allow price to rise violently, admit failure. Both outcomes destroy confidence. And confidence, once lost, never returns cheaply. What happens next is not negotiable. Markets can delay reality. They cannot escape it. The silver market is approaching a moment where paper and physical must reconcile. When that happens, it will not look like a normal bull market. It will look like a repricing event. The banking fracture. When derivatives meet reality. This is not a metals problem. This is a banking problem. Silver is not the disease. Silver is the diagnostic test. What is failing right now is not just a commodity market. It is the derivatives-based financial system that sits beneath it, a system built on leverage, on promises, on settlement instead of delivery, and silver is exposing it. Bullion banks are not dealers, they are structural shorts. Bullion banks are often described as intermediaries. That description is false. They are directional participants. For decades, bullion banks have operated with one structural assumption. Physical delivery will always be small. Based on that assumption, they built enormous short positions in paper silver. Not hedges, not inventory offsets, synthetic supply. This worked because confidence worked. Until now, the silver derivatives pyramid. The silver market is not a straight line. It is a pyramid. At the base is physical metal. Above it are ETFs. Above that are futures. Above that are swaps, options, forwards, unallocated accounts, and OTC contracts. Each layer multiplies claims on the same underlying ounces. By the time you reach the top, 1 ounce supports dozens, sometimes hundreds, of claims. This structure is not illegal. It is simply fragile. Derivatives require stability. Silver is destabilizing them. Derivatives function under one key condition: predictability. They assume delivery will be rare, volatility will be manageable, correlations will hold, liquidity will always appear. Silver is breaking all 4 assumptions at once. Physical demand is rising, volatility is increasing, correlations are failing, liquidity is evaporating. That is how derivatives turn from tools into weapons. The unallocated illusion. Much of the silver owned in the West is unallocated. Unallocated means no specific bar, no serial number, no immediate delivery guarantee. It is effectively an IOU. As long as clients do not ask for metal, this works. The moment they do, the system reveals its weakness, because unallocated silver does not represent stored metal. It represents confidence, and confidence is leaking. When clients changed their mind for years, institutions were content with exposure, and they wanted price movement, not metal. That behavior is changing. Now they want allocated metal, immediate delivery, jurisdictional certainty. This shift is small in percentage terms, but devastating in structural terms, because the system was never built to handle it. The delivery bottleneck. Delivery is not just about inventory, it is about logistics. Refining capacity, transport availability, vault access, regulatory clearance. When demand spikes simultaneously across regions, these bottlenecks become fatal. Delays become normal, premiums explode, confidence collapses. And once clients experience delay once, they never forget it. The short position trap. Bullion banks cannot simply step away from silver. Their short positions are embedded across futures swaps, structured products, client hedges. If price rises slowly, they manage. If price rises violently, they lose control. Covering shorts requires buying contracts. Buying contracts drives price higher. This creates a positive feedback loop. Margin is the first crack. As silver rises, margin requirements increase. This forces leveraged players to post collateral. Some can, some cannot. Forced liquidation follows. But here's the problem. Liquidation does not release metal. It only redistributes paper. The physical shortage remains. Why central banks are uncomfortable. Silver is not officially monetary, but it behaves monetarily. It reacts to currency debasement, sovereign risk, inflation expectations, trust erosion. Central banks do not like markets they cannot openly control. Gold can be leased, currencies can be printed, bonds can be bought. Silver is harder, its market is smaller, its supply is tighter, its industrial role is unavoidable. Intervention has limits. Authorities can intervene in price, they can pressure banks, they can expand paper supply, they can signal calm. What they cannot do is create physical silver. And every intervention that suppresses price worsens the physical drain. This is the paradox. Control accelerates collapse. The liquidity mismatch. Banks fund short-term liabilities with long-term assumptions. Silver breaks that. When clients demand delivery now, but metal arrives later, the mismatch becomes visible. Accounting hides it. Markets expose it. Why default is not announced. It is implied. Markets rarely declare default explicitly. They imply it through behavior. Cash settlement instead of delivery. Delays labeled as technical, premiums, disconnected from spot rule changes during stress. Each one is a signal. Together, they are a confession. The moment confidence breaks. Confidence is binary. It exists until it doesn't. Once market participants believe delivery may fail, behavior flips instantly. Exposure becomes risk. Paper becomes suspect. Metal becomes king. At that point, price becomes irrelevant. Only access matters. Why this is bigger than silver? Silver is simply the smallest market with the biggest leverage. It breaks first. But the same structure exists in gold energy base metals, sovereign debt. Silver is the canary. Banks are not prepared for a run on metal. Banks prepare for credit risk, market risk, liquidity risk. They do not prepare for delivery risk, because delivery risk was never supposed to matter, until it did. The psychological shift. For decades, metals were financialized. Now they're being re-physicalized. That shift is irreversible. Once institutions relearn the value of possession, they do not return to trust easily. What happens when shorts panic short covering is not orderly. It is frantic. Buy orders hit thin markets. Offers disappear. Spreads widen. Price gaps. This is how silver moves $5, $10, $20 in days. Not because demand changed, but because structure failed. Why governments will blame everything except the system. They will blame speculators, geopolitics, supply shocks, misinformation. They will not blame leverage. They will not blame derivatives. They will not blame themselves. But the market will not care. The moment of repricing. Repricing is not appreciation. It is recognition. Recognition that paper claims were mispriced. Recognition that physical scarcity was ignored. Recognition that trust was abused. When repricing happens, models break. This is why silver moves last and fastest. Silver is ignored until it isn't. When it moves, it does not ask permission. It forces adjustment, and adjustment is painful. The system is not evil. It is simply over-leveraged. This is not conspiracy. It is math. Too many claims, too little metal, too much confidence, and now, too much reality. The window is closing. Markets always offer a window, a moment where signals are clear, but action is optional. That window never stays open. Once closed, behavior changes, and prices follow. This is the last warning metal. Silver does not whisper. It screams. And right now, it is screaming that the system beneath it is cracking. The great repricing, when the illusion finally dies. This is how systems end, not with a crash, but with a realization. Financial systems do not collapse the way movies portray them. There is no single moment, no universal alarm, no dramatic announcement. They end when enough participants quietly realize the same thing at the same time. The price is wrong, and it cannot be fixed. That realization is now spreading through the silver market, silently, relentlessly, irreversibly. Repricing is not a rally, it is a confession. A rally implies enthusiasm. Speculation, momentum. Repricing is different. Repricing is an admission that the previous price was a lie. Silver is not rising because people suddenly love silver. Silver is rising because the system that priced it failed. And once a market admits failure, it does not return to normal. The three phases of a metal event. Every monetary metal event follows the same pattern. Phase 1, denial prices are capped. Narratives dominate. Experts explain why this time is different. Phase 2, dislocation. Premiums detach from spot. Delivery delays appear. Physical trades ignore paper quotes. Phase 3, recognition. Price gaps violently. Liquidity vanishes. Control is lost. Silver is transitioning into phase 3. What triggers the final move? Contrary to popular belief, the final move is not triggered by demand. It is triggered by refusal. Refusal to sell metal at paper prices. Refusal to accept cash settlement. Refusal to roll contracts forward. The moment sellers disappear, price becomes meaningless, and markets do not tolerate meaninglessness. The day, quotes, stop mattering. There comes a day in every broken market when the screen price becomes irrelevant. On that day, dealers quote, subject to availability. Premiums change hourly, delivery dates become estimates. Size determines price. This is not chaos. This is truth replacing abstraction. Why $100 is not a target. It is a signal. People fixate on numbers. $50, $75, $100. But numbers are not the story. $100 silver is not the destination. It is the moment the market admits it lost control. Once that happens, the question is no longer, how high can silver go? The question becomes, how low was it before? The inventory reset. When repricing begins, inventories do not refill. They disappear. Holders stop selling. Producers stop hedging. Recyclers wait for higher bids. Metal becomes strategic. And strategic assets do not flow freely. Why supply will not save the market? Rising prices are supposed to incentivize supply, but silver supply is not elastic. Mines cannot ramp quickly. New projects take years. Recycling lags price. This means repricing outruns production, always. Industrial buyers will not wait. Industry does not speculate. Industry secures inputs. When silver becomes scarce, manufacturers do not negotiate. They prepay, they overbid, they stockpile. This behavior accelerates price moves far beyond financial logic. The price ceiling is a myth. People assume governments will cap the price. History says otherwise. Governments can cap paper trades. They cannot cap physical necessity. When industry must choose between paying more or shutting down, price wins. Every time. The psychology of panic buying. Panic buying is not emotional, it is rational. It occurs when participants believe future availability is uncertain. In metals, this belief spreads faster than facts, and once it spreads, it does not reverse easily. Why silver will outrun gold? Gold moves when trust erodes. Silver moves when systems fail. Silver's market is smaller, its supply is tighter, its leverage is higher. That makes its repricing more violent. The moment paper is abandoned. At some point, large players stop using futures to gain exposure. They use futures only to secure delivery. This changes everything. Open interest collapses, volatility spikes, price gaps appear. This is how paper markets die. The role of exchanges. In the final act, exchanges do not fail dramatically. They adapt. Contract specifications change, settlement terms evolve, force majeure clauses appear. Each change is justified as temporary. None of them are. Cash settlement is not a solution. It is an admission. When a market settles in cash instead of metal, it tells you one thing. The metal is not available at the quoted price. That is not stability, that is default, politely worded. The media will miss it. Mainstream media will not call it a repricing. They will call it volatility supply disruption. Speculative excess. They will focus on symptoms. They will ignore structure, because structure implicates the system. What history will say? Years from now, this period will be described differently, not as a silver bull market, but as the moment the world rediscovered the difference between price and value. The East will not sell back. A critical mistake many analysts make is assuming metal will flow back once prices rise. It won't. Metal that leaves the West does not return easily. It becomes part of strategic reserves, industrial stockpiles, sovereign planning. Those ounces are gone. The West will pay any price or admit failure. When inventories run thin, choices disappear. Markets either reprice violently or stop functioning. Functioning markets require trust. Trust requires delivery. Delivery requires metal. This is why timing no longer matters. People ask when? Weeks, months, years? Timing matters only before repricing begins. Once it starts, time compresses. Moves that should take years happen in days. The final stage, normalization at a higher reality. After repricing, markets stabilize, not at old prices, at new ones. Prices that reflect scarcity. Prices that discourage waste. Prices that reward possession. This is not collapse. This is correction. What comes after? Silver will not be alone. Other markets will follow, because the structure that failed here exists elsewhere. Silver is simply first. The real message of $100 silver. The message is not buy silver. The message is systems built on leverage fail when reality asserts itself. Silver is just the messenger. This is not about profit. It is about position. Those who understand this shift do not chase returns. They secure position. They prioritize access over yield. They value certainty over exposure. The final thought: markets are stories we tell ourselves. Stories about liquidity, stories about efficiency, stories about control. Silver is ending one of those stories, quietly, relentlessly, without asking permission. When the screen goes silent, there will be a moment when prices stop updating smoothly, when spreads widen too far, when quotes disappear, when availability replaces price. That moment will not feel dramatic, it will feel final. This is the great repricing. Not a rally, not a bubble, not a mania, a recognition that the East did not raise the price. Reality did.